Our next presenter will be Steve Lubart. He is going to present on tax benefits of charitable contributions for donors. A little bit about Steve. He is a member of the firm. He is also in our Camp Hill office, joined SEK in 1996, and he now has 30 years of experience. Graduated from Shippensburg University with a bachelor's in accounting, provides tax and consulting services to closely held businesses and individuals. Industry specialties include professional services, retail, and healthcare. And a fun fact about him, his birthday is the tax deadline of April 15th.
Thanks, Christina. You hear me there?
Everything good? Go ahead.
Oh,
thanks.
All right. Thanks. Thanks, everybody. Good morning. This is kind of an interesting topic because it affects your organization, your nonprofit, but then it also impacts you personally because each one of us are donors as well. So I'm going to kind of lay the groundwork of some of the contribution donations and how it affects your organization, and then in the tail end get into just the tax impact of changes for 2026, because as we know, there's always tax law changes, and we want you to be informed of how that impacts your organization, how it impacts your donors, and how it impacts you personally, because I'm sure you're a contributor to your organization and to others. So tax-efficient charitable giving has become a critical component of nonprofit fundraising strategy, particularly in an environment where donors are increasingly sophisticated and focused on maximizing impact while managing their tax exposure. For nonprofits, controllers and CFOs like you need to understand these strategies so you can provide personal tax advice, not provide personal tax advice, but rather enable informed conversations with your donors. Larger and more strategic donations are often unlocked when donors understand these strategies, and they'll give generously. Financial leaders play a central role in shaping gift acceptance policies, ensuring compliance with federal and state regulations, and partnering developing teams to communicate opportunities responsibly. As tax laws evolve and standard deductions remain high for many taxpayers, donors are seeking alternatives to restore their tax efficiency and their philanthropy. By being conversant in these strategies, nonprofit financial leaders like yourself can help protect the organization, improve donor trust, and support sustainable growth. This session will focus on framing the gifts of planning and transactional events while reinforcing your nonprofit role as a trusted steward. Okay, the primary objective here is just educational, as well as talking about the diverse contribution types, and then also touching on the compliance side of it, because you need to be in compliance, providing, letters, receiving the contributions properly, and adhering to the rules. Looks like you have a poll question there, so take that, and then we'll jump into the next slide. All right. So cash versus non-cash contributions. Cash contributions, as they sound, those would be checks, credit card, actual cash, whereas non-cash contributions would be items that could be goods, could be artwork, could be securities, could be a home, property. So organizations that are accepting non-cash contributions need to be prepared and compliant on accepting those, being able to evaluate them, being able to determine what the overhead costs might be of taking those on, having brokerage available to be able to take on those securities. So there's different things when you're looking at non-cash, but there's a lot of benefits for non-cash contributions that for the taxpayer that should be considered. So let's look at the next slide as far as appreciated securities and their high impact tax strategy. So appreciated securities, just to give you an example of that, donors can avoid capital gains for accepting appreciated securities. For example, if we use a stock, for example, we'll use Apple stock, a common stock. So if you would, um, let's say you bought Apple stock for $100 and it's worth $1,000 now, and you wanted to give that money to the charitable organization. If you sold that stock, you would recognize a $900 gain on the sale of that stock and pay tax on that, and then give the contribution of the $1,000, as opposed to if you gift appreciated stock, like the Apple stock, you could donate the $1,000 and in turn not recognize the capital gain and get the full $1,000 charitable deduction for that. So I'm sure that your organizations are receiving appreciated stock, but that's something that we just want you to be educated on and be able to have those acceptance requirements, and of course, providing the paperwork to them for acknowledgement of receipt and the proof of the charitable deduction. And I'm kind of setting these up for just some of the basics here for them when we get into the rules for 2026 tax law. So some of these might be very familiar with you, but just want to kind of lay the baseline. The next one's qualified charitable distributions from IRAs. So taxpayers are required or they're able to give QCDs, which are qualified charitable distributions. That age has been raised to 73 when you are required to do RMDs or required minimum distributions, but you can do QCDs, qualified charitable distributions, at 70 and a half from your IRAs. Why this is beneficial is that QCDs or qualified charitable distributions, that enables you to, for example, if you can do this up to 100,000, that would anywhere from what your minimum is up to 100,000. Let's say a taxpayer had a $100,000 required minimum distribution, and they had that donated all to your charity. They would be able to not they would get the full tax break, but it wouldn't run through Schedule A as itemized deductions. It would actually be reported on the front page of their 1040, but none of it would be taxable. So it wouldn't be subject to any type of phase outs or dealing with anything on Schedule A. So the advantage there is that it wouldn't result in affecting their AGI as far as phase outs for other deductions. Also, it would just be smoother. Now, if you take someone, for example, like a $10,000 QCD, what they would be able to do is with that is they may not be itemizing because the itemized deduction limit is high. So they could have the benefit of donating that whole RMD or qualified charitable distribution and in turn not get taxed on that. And so it'd be tax free. And if they would have taken the distribution and ran it through Schedule A of itemized deductions and they didn't qualify for itemized because of the high standard, they wouldn't get any tax benefit from that. So that's the attractive side of the qualified charitable distributions from your RMD. So that should be considered for the people that are in that age group. And I think you should educate the donors on that opportunity, and they should talk to their financial advisor to see if they might benefit from that. One other point with that is with the large QCDs is this can provide opportunities where, because a lot of high people and their seniors that are eligible for Medicare, it's based off of their the IRMA or the Medicare's premium is based off of what their adjusted gross income is. So if they would run it through a QCD, this RMD would not be wouldn't go into the calculation for the IRMA, which is the Medicare premium. So that's something to educate and to consider for them because people are concerned about those rising health insurance Medicare costs. So besides tax planning, we see it as far as IRMA planning, and that's what a lot of financial advisors are helping on, and we're trying to do that as well. The next slide is related to donor advised funds, and we look at this as we also call that a bunching strategy. So we see this a lot with taxpayers when they have a large taxable event, like they sell their business and they have a large capital gain. Maybe they sell stock with a large capital gain, but it's a big taxable event that occurs. Maybe they get a large bonus. And the donor advised funds, and it's really just like a mutual fund, but it's earmarked for charity. So the donor advised funds, for example, if I had someone that wanted to do, for example, like $250,000 into a donor advised fund, uh, they could get they could get that deduction all in 1 year, uh, as opposed to if they, and that would provide maybe lifetime giving where they were going to give $10,000 for a year for 25 years. They could take all of that deduction in year one when they put it in a donor advised fund. And that would provide opportunities that they had this bucket here that was for charity. And then they may not even know what they're going to give their contributions to at the time they put in a donor advised fund. But this would be a way that they then, when they have organizations that come up that they want to give to, they have it all earmarked for that. So we see that as a way to get a large contribution all in 1 year. And maybe if they're giving, for example, $10,000 a year, they may not even be getting any tax benefit from that because they're taking the standard deduction. And the next slide relates to real estate, liquid assets, trust strategies. These are a little bit more complex, but we'll see that a common one might be that someone wants to donate a property to a nonprofit organization. For example, they might have a property that could be housed to that nonprofit organization. It may be next to that nonprofit organization. So in that, there's an appraisal that's needed on the property. And if someone was going to sell that property, if it wasn't their personal residence per se, maybe it was a rental property, they would recognize a gain on the sale of that property for whatever their tax basis is compared to the sale price. But if they in turn donated that to the nonprofit organization, they would get a deduction for the itemized deduction for the full cost of that property. So that's a nice tax benefit there, and something that should be considered as you're talking to your donors about just an educational properties that they have. The next is just substantiation documentation. I'll touch on this quickly. This would just be, you want to have the processes set up in place and your gifting policies and you're issuing letters and you have the internal controls set up there. So that's something that's worth your auditors reviewing and just reviewing on a annual basis to make sure that there isn't any holes in what you're doing there as part of a nonprofit organization. The next item relates to the Pennsylvania Education Improvement Tax Credit. This is an item that we see a lot of our clients aren't aware of, and we're trying to educate them on. The EITC is really one of the best credits out there. Some of your organizations may be part of the EITC for Pennsylvania, but it's really involved with an educational arm. We saw it most in really the private schools, but we're seeing it in other organizations that provide education like the YMCA and others. So if you have an educational arm, you might want to look at applying for this if you're not already. But where this benefit is the largest is under the EITC for Pennsylvania. If someone commits to giving for 2 years into the EITC, they save 90% of that deduction or that contribution for state tax. So a $10,000 contribution into the EITC program would save $9,000 in state tax. If you did a 1-year commitment, it would save $7,500 of state tax. The portion that's not deducted or isn't eligible for the credit, for example, the other 1,000, you could take that as an itemized deduction. So this is one of the best credits out there. Now, let me just touch on a couple things here on the next slide, which would be the tax law changes for. We can go ahead and skip over that one, Christina, for the sake of time. So the tax law changes impacting donor strategies. So these would be tax law changes for 2026. There's a higher standard deduction for itemizing or higher standard deduction. So itemizing becomes a little more difficult to do compared to when the standard deduction was a lot lower prior to 2017. So the standard deduction for singles 16.1, married filing jointly is 32.2. So we have a lot of people that are giving that may not be getting a tax break for in the itemized deduction section. But we are seeing with this new change, the higher SALT cap, so that's state and local tax. You may have heard this was limited to $10,000. That has been raised to $40,000 and begins phasing out for married, filing separate at 250 and 500K for single and married. So this is opening up that more people can itemize. So you want to educate your donors on this. But the real estate taxes and state and local taxes was capped at 10, now it's up to 40. Next item is the above the line deduction. So anybody who isn't itemizing, but they are, we'll call this smaller contributors, they can contribute up to $1,000 or $2,000 for married and be able to take an above the line deduction to public charities. Whereas if they weren't itemizing, they wouldn't get that tax break. So this is new for 2026. So you want to educate your donors on that. Fortunately, donor advised funds aren't eligible for this. We touched on the QCD planning already. So considering that up to $100,000 from IRAs. The cash limit for adjusted gross income is up to 60%. And appreciated assets is up to 30% of AGI. One other item that I don't have on that slide is, this is new for 2026, is that there is a floor of 0.5% of AGI for itemizers. So someone who has, if they're itemizing and they have an AGI of 200,000, their first $1,000 they're not able to take as an itemized deduction or above the line deduction. So someone with 200,000 would need to give over $1,000 for each of that dollar over 1,000 to count. Something to be considering, just where people fall into the high income earners. We're looking at donor advised funds and also bundling of contributions and also appreciated assets. Retirees, we're looking at QCDs and IRA giving. Business owners and individuals are eligible for the EITC. They receive a K-1 from that shows the credit. And then entity level giving for business owners, if they're giving money within their organization, it would either be taken at the entity level or flow through personally. Decision framework would just be someone over 70. We're looking at QCDs, as we mentioned, bunching if they're near the threshold to get them over. So that's bunching is either doing a donor advised fund or they're making 2 years worth of contributions in 1 year. So 1 year they're itemizing, the next year they're taking the standard deduction. Those considering itemizing because of the SALT level. So, and then the above of the line deduction for small donors. So more people eligible now with the above the line deduction. And then the EITC for PA, I would really encourage you to look into that because that's the, like I said, the best tax break that we have out there right now. Sorry to rush through that. I'll take any questions that people have related to the tax law changes in 2026.
Okay, we have one question. It's kind of a two-parter, so I'll just do the first half First, are in-kind services by small businesses considered an attractive donation option with tax benefits? For example, an electrical company prices a large electrical project on a capital campaign build at 300,000 but reduces it by $50,000 as in-kind.
Yeah, so that what happens there is that they don't if they're really only getting the deduction for what their labor and goods are, so that the organization or that company's not really getting any tax benefit for the $50,000 deduction. Of course, the organization really appreciates it, but really where they're getting their deduction is the labor and which is their normal cost, and also they're getting a deduction for the materials that are involved.
And the second part is also the small business who reduces our service cost by 20% on every invoice throughout the year. Is this an attractive way for small businesses to contribute to a local nonprofit?
Um, Yeah, it is. It's attractive to them because they're maybe not having, the cash outlay to that organization. So they're not out that money. They're just really out what additional profit they would have received or the recoup of cost. But it is, it's attractive to them because they're supporting your organization, and they're not spending the extra dollar. They're just foregoing the profit.